Welcome, my friends. The news today is that bank deposits are under pressure. Since the failure of Silicon Valley Bank, bank depositors have been moving their deposits. Mostly from bank to bank. But also from bank deposits to money market funds. And, if you follow this channel, you already know that Fitch has warned that it may be forced to downgrade dozens of banks, including JP Chase. Fitch Ratings cut its assessment of the banking industry's health in June, a move that analyst Chris Wolf said went largely unnoticed because it didn't trigger downgrades on banks. If you follow this channel, you know that Moody's Analytics has already cut ratings of 10 US banks and put some big names on downgrade watch. Among the smaller lenders receiving an official ratings downgrade were M&T Bank, Pinnacle Financial, Bach Financial and Webster Financial. Major lenders Bank of New York Mellon, US Bancorp, State Street, Truist Financial, Cullen/Frost Bankers and Northern Trust are now under review for a potential downgrade. Banking turmoil has taken another step up. As you probably recall, a number of banks have failed so far in 2023. Silicon Valley Bank, Signature Bank, First Republic Bank, Silvergate Bank voluntarily shut down and went out of business. And Pacific West Bancorp was forced to merge with Bank of California just last week. What does it mean for the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And, before we continue, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions. Doctors, including any type of specialty. Nurses, and that includes all grades of nurses. Lawyers, regardless of area of legal focus. Teachers and professors, from kindergarten through graduate school. As well as any kind of job that requires a government license or certification. And ProWorld.net also includes short-term gig-type jobs as well. So, be sure to check out ProWorldNet.com if you are looking for a job or an employee. Deposits at the 25 largest domestically chartered U.S. commercial banks peaked at $11.680 trillion on April 13, 2022, according to the updated H.8 data maintained at the Federal Reserve Economic Database, FRED. As of the most current H.8 data for the week ending on Wednesday, July 26, 2023, deposits stood at $10.709 trillion at those 25 commercial banks, a dollar decline of $970 billion and a percentage decline of 8.3%. Equally noteworthy, the decline shows no signs of letting up. According to the FRED data, between July 5 and the most current reading on July 26, the 25 largest U.S. banks shed $174 billion in deposits. Despite all of the misleading news reports about depositors seeking out the perceived safety of the largest banks since the banking crisis in the spring, it's actually been the smaller banks that have staged a comeback on growing deposits since the week of April 26. As of March 31 of this year, according to FDIC data, there were a total of 4,096 commercial banks in the U.S., meaning that if you segregate the 25 largest banks, that leaves 4,071 falling into the H.8 category of small, domestically chartered commercial banks. This breakdown does not give the American people a quick pulse beat on the dangers lurking in the U.S. banking system, a system that imploded in 2008 and was on its way to imploding again this spring until the Fed stepped in with another bailout program. In the span of 7 weeks this spring, running from March 10 to May 1, the second, third, and fourth largest bank failures in U.S. history occurred. The largest bank failure in U.S. history, Washington Mutual, occurred in 2008 during the financial crisis. Because there are only 4 domestically chartered commercial banks in the U.S. with more than $1 trillion in deposits. JP Chase, Bank of America, Wells Fargo, and Citigroup Citibank. That is especially true given that one of those 4 banks, Citigroup, blew itself up in 2008 and received the largest Fed and Treasury bailout in U.S. banking history. Given this history, it would make far more sense for the Fed to provide this deposit data in the following breakdowns: deposits at mega banks with more than $1 trillion in deposits, deposits at large banks with $200 billion to $1 trillion in deposits, and deposits at small and medium banks with less than $200 billion in deposits. Monitoring what is going on at these 4 behemoth banks should make nightly network news and the front pages of newspapers, but rarely does. This lack of media attention allows a 5-count felon bank like JP Chase to continue its serial crimes while simultaneously getting bigger. JP Morgan Chase was allowed by federal regulators to gobble up the failed First Republic Bank this year, despite the fact that JP Morgan Chase is currently being credibly charged in federal court by the Attorney General of the U.S. Virgin Islands with actively participating in Jeffrey Epstein's sex trafficking of underage girls for more than a decade. What could be more damaging to a mom and pop bank's reputation, with more than 5,000 Chase Bank branches dotting the landscape across America, than credible charges from the Attorney General of the U.S. Virgin Islands that JP Morgan Chase sold out young girls as sex slaves for more than a decade in order to get wealthy client referrals from Jeffrey Epstein? The 11th Circuit Court of Appeals called what the U.S. Department of Justice allowed to happen to these girls beyond scandalous and a national disgrace. And yet, the U.S. Department of Justice has left it to the Virgin Islands to bring civil charges while it remains missing in action on bringing criminal charges against JP Morgan Chase. Allowing a bank with this serial history of outrageous crimes to get even bigger and more dangerous did not escape the attention of Senator Elizabeth Warren. On May 17, Warren sent a letter to federal regulators pointing out the problems with the JP Morgan Chase/First Republic deal. Warren wrote, "It resulted in a $13 billion cost to the Federal Deposit Insurance Fund, which will ultimately be passed on to ordinary bank consumers across the country, and made JP Morgan, the nation's biggest bank, even bigger." Warren's letter also noted the following. Under the Regal-Neal Interstate Banking and Branching Efficiency Act of 1994, a bank holding company may not consummate a merger that would result in the bank holding more than 10% of the nation's total deposits, a standard that JP Morgan already exceeds. However, because Regal-Neal includes an exception for failed banks, the OCC has indicated that it did not need to take any action because the statute automatically provides a waiver. In its May 1 letter approving JP Morgan's acquisition of First Republic, the OCC concluded that the transaction does not increase risk to the stability of the United States banking or financial system as it facilitates the orderly resolution of an insured depository institution in default, though it provides little detail about its analysis. There is a very compelling argument to be made that the JP Morgan Chase/First Republic Bank combination did, indeed, increase risk to the stability of the United States banking or financial system, because federal regulators had already assessed JP Morgan Chase to be the nation's riskiest bank. And, if you follow this channel, you already know that Fitch has warned of banks under review for downgrades. A Fitch ratings analyst warned that the U.S. banking industry has inched closer to another source of turbulence, the risk of sweeping rating downgrades on dozens of U.S. banks that could even include the likes of JP Morgan Chase. The ratings agency cut its assessment of the industry's health in June, a move that analyst Chris Wolf said went largely unnoticed because it didn't trigger downgrades on banks. The credit rating firms relied upon by bond investors have roiled markets lately with their actions. Last week, Moody's downgraded 10 small and mid-sized banks and warned that cuts could come for another 17 lenders, including larger institutions like Truist and US Bank. Earlier this month, Fitch downgraded the U.S. long-term credit rating because of political dysfunction and growing debt loads, a move that was derided by business leaders including JP Morgan CEO Jamie Dimon. This time, Fitch is intent on signaling to the market that bank downgrades, while not a foregone conclusion, are a real risk, said Wolf. The firm's June action took the industry's operating environment score to AA from AA because of pressure on the country's credit rating, regulatory gaps exposed by the March regional bank failures and uncertainty around interest rates. The country's two largest banks by assets, JP Morgan and Bank of America, would likely be cut to A+ from AA in this scenario, since banks can't be rated higher than the environment in which they operate. In terms of what could push Fitch to downgrade the industry, the biggest factor is the path of interest rates determined by the Federal Reserve. Some market forecasters have said the Fed may already be done raising rates and could cut them next year, but that isn't a foregone conclusion. Defaults tend to rise in a rate-hiking environment, and Fitch has expressed concern on the impact of office loan defaults on smaller banks. In the wake of the recent Moody's cuts, Morgan Stanley analysts said that downgraded banks would have to pay investors more to buy their bonds, which further compresses profit margins. They even expressed concern some banks could get locked out of debt markets entirely. Moody's cut the credit ratings of a host of small and mid-sized U.S. banks a couple of weeks ago and placed several big Wall Street names on negative review. U.S. banks continue to contend with interest rate and asset liability management, ALM, risks with implications for liquidity and capital, as the wind down of unconventional monetary policy drains system-wide deposits and higher interest rates depress the value of fixed-rate assets, Moody's analysts Jill Satina and Anna Arsev said in the accompanying research note. This comes as a mild U.S. recession is on the horizon for early 2024 and asset quality looks set to decline from solid but unsustainable levels, with particular risks in some banks' commercial real estate, CRE, portfolios. Interest rates are likely to remain higher for longer until inflation returns to within the Fed's target range and, as noted earlier, longer-term U.S. interest rates also are moving higher because of multiple factors, which will put further pressure on banks' fixed-rate assets. Risks may be more pronounced if the U.S. enters a recession, which we expect will happen in early 2024, because asset quality will worsen and increase the potential for capital erosion, the analysts added. Though the stress on U.S. banks has mostly been concentrated in funding and interest rate risk resulting from monetary policy tightening, Moody's warned that a worsening in asset quality is on the horizon. The failures of Silicon Valley Bank and Signature Bank in March were the third and fourth biggest ever. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.